to our financial markets course, we are on Unit 3, that is the stock market in the central bank. And here we are considering the efficient market hypothesis. So by the end of this session, you should be able to explain the meaning of the efficient market hypothesis, discuss the distinguishing characteristics between weak, semi-weak, and strong forms of market efficiency. So financial markets are said to be efficient when the prices quoted in the market reflect all available information in the market. So the efficient market hypothesis is a theory that states that the prices of security in the financial markets must fully reflect all available information in the efficient market such that market players would not make abnormal profits from the privileged information. So with the efficient market hypothesis, or wait, let me start with the efficient market. A market is efficient if the available circumstances in the market is able to reflect all information needed for prospective operators in the market so that nobody makes an abnormal profit in the market. So with the efficient market hypothesis, we are saying that for a market to be efficient, the financial market or the particular market must fully reflect all available information. And the emphasis here is all available information. So you don't go to the market and ask questions. Once you get to the market, all information you need are provided, and players are able to make good use of the market so that nobody gains abnormal profits from the privileged information. So that an investor cannot beat the market or get more returns than what the market offers only by selecting some securities or timing its activities in the market. So here we are saying that no investor is able to beat the market. You are not able to outsmart the market and make any form of abnormal. And we know that the efficient market hypothesis is an important feature of every market. But currently, due to a lot of issues and conditions that are hidden in the market, we are saying that not all markets are efficient. That is in reality, not all markets are efficient. So there are some points that support or are favorable to the efficient market hypothesis. So some of these facts are that investment analysts and mutual funds don't beat the market. So those who are supporting the efficient market hypothesis claim that investment analysts and mutual funds supporters are not able to beat the market. Also, the stock prices reflect publicly available information because anticipated announcements don't affect stock prices. Also, the stock prices and exchange rates are close to random walk. So with random walk, we are saying that the stock prices and the exchange rates follow a random walk. So in following a random walk, it means that stock prices reflect the general happenings of the market and no one can predict what will happen in the future. Also, technical analysis do not outperform markets. So no matter the technical or the wisdom you apply to outsmart the markets, it doesn't work. The market just reflects what is happening at the moment. But you know that in our current situation, there are lots of abnormalities in the market. Some of these abnormalities include January effect, evidence of consumers or investors reducing their trade once they presume certain happenings. Also, pricing situations in the stock market also affect the behavior of the stock market. So in actual sense, we are saying that even though the efficient market hypothesis has some good qualities, there are limitations because our current market conditions may not always reflect all the available information in the market. And there are types of market efficiency. So we have the strong form market efficiency, semi-strong form market efficiency, and the weak form market efficiency. So with the weak form market efficiency, we are saying that the share prices reflect only past information. So with the weak form of market efficiency, we are saying that the market conditions or the price shares, the share prices reflect only past information of the securities. So once you are getting past information, you are not able to tell what is happening at the moment. And this form of market efficiency suggests that technical analysis can be used to predict the market to a point. And research has shown that most markets exhibit this form of efficiency. And we also want to look at the semi-strong form of efficiency. So with the semi-strong form of efficiency, the security prices reflect past and publicly available information for the security. So unlike the weak form of security where only past information are available on the market, with a semi-strong form of efficiency, past information as well as publicly available information are available on the market. So there's no value in trading on new information by the investor. And this form of efficiency means that market forces react quickly to reflect new information that is introduced in the market, in addition to reflecting past information. And then finally, we want to consider the strong form of market efficiency. So the strong form of market efficiency, we are saying that the share prices reflect all available information, both the past, the present, those available to public as well as private individuals. So investors do not get any value when they trade on any other kind of information, whether past, public or private, since the market already shows or reflects all forms of efficiency. So an efficient market can exist if the following events occurs: when there's a large number of rational, profit maximizing investors who exist and actively participate in the market by analyzing, valuing and trading stock. Also, when the information is costly and widely available to all market participants, the efficient market condition can exist. Also, when investors react quickly and accurately to new information, causing stock prices to adjust accordingly, then under these conditions we can say that the efficient market hypothesis can work. But until then, we'll have to take note that market conditions are not efficient. All too soon, we've come to the end of this session and we've learned about the efficient market hypothesis. We've also had some supports and criticisms of the efficient market hypothesis, and we've looked at the three main types of efficient market hypothesis, that is the weak form of efficiency, the strong form, as well as the semi-strong form of efficiency. Thank you so much for your attention and see you in our next session. Bye.